Here we are, now at the first of the big four securities laws, the Securities Act of 1933. You are going to need to know these laws likely by name. A lot of students always focus on the years, the 33 Act or the Act of 34 or the two acts of the 1940s. I always focus on the names. I like to joke, though I'm actually rather serious about it, that at least when these laws were written, Congress people didn't really have a sense of humor. They didn't go and make cute acronyms and cute names for laws. They just named the laws what they did, at least in these cases. The Securities Act is the act that regulates securities, the physical securities, the paper, the physical certificates. The Securities Act of 1933 is the Paper Act. It regulates what's called the primary market. We're going to get into that a bit more in Unit 3 in this section. But basically, it's the new issue market. There's a cooling off period of 20 days where there's no solicitation. You can only get indications of interest. You can try and remember the acronym SARS. That is no selling, advertising, recommending, or soliciting. If at any point this cooling off period is stopped, there's additional reports that are needed, additional documents or something. Once those documents are submitted again, it's going to restart from where it left off. It's not going to start over. It's just going to continue from where it left off. If it left off on day 11, it comes back on day 11. An issuer. This is the organization that actually is issuing the securities. IBM issues IBM bonds. Microsoft is the issuer of Microsoft stock. Underwriters, we mentioned these a little bit in Chapter 1 when we were talking about how securities come to market. The underwriters are investment banks. These are the people that bring securities to market. They work by contract. Basically, the issuer and the underwriters are going to talk together, and I say underwriters because normally they form what's called a syndicate. That's multiple underwriters together. Even these banks, when we start seeing the names and you think about how huge they are, none of them can still really risk these failing. So they join together. But they work by a contract. Depending on which contract depends on how the underwriter is going to get paid and how much they're going to get paid. Basically, the more risk that the underwriter has, the more they're going to be getting paid by the issuer, at least out of their cut. Best efforts. This is when the underwriter is agreeing to try to sell. By using their best efforts, they are going to attempt to sell all the securities. But whatever they don't sell gets returned to the issuer. I'm an issuer. I want to raise $100 million. So I get an underwriter with best efforts to come in. Maybe they sell 99 million, in which case 1 million gets returned. That's pretty good. I got most of what I wanted. Maybe they sell 5 million, in which case 95 gets returned. They get paid for what they sell, so they didn't really lose much. There isn't really much risk here for the underwriter. Much more risk here for the issuer in that my issue is going to fail and I'm going to get returned a bunch of basically worthless stock that I couldn't sell and can't do anything with. It could be an all or nothing. This is where the underwriter is either able to sell all the securities or none of them. I go and say, I want $100 million. A penny less isn't worth it to me. I need the full $100 million or I can't do what I want. I'm not interested. It's related to a mini-max. This is where there is a minimum I'd accept. I want $100 million, but I guess if I get 60, I could do that other project. The 100's for the big one, but I guess if I get at least 60. So the minimum is sold in this case, whereas in the all or nothing, the minimum is effectively the all of them. In these two types of underwritings, the phrase escrow may come up. The idea of an escrow account is sort of a triggered transfer account. The investors put their money in the escrow account. The underwriters and the issuer put the shares to match up against that money. If enough of them sell and if the issue goes through, that is, if all of them sell in an all or nothing or the minimum sold in a mini-max, then the shares go to the investors, the cash goes to the issuer's underwriter. If, however, they don't sell, the cash goes back to the investors and the shares go back to the issuer and underwriter. A standby underwriting. This is directly related to the rights, the common stock rights to maintain proportional ownership. I mentioned there are 3 ways we discuss them. Once when we talk about common stock, where they have the right to maintain their proportional ownership. Again, when we talked about the derivative called a right, a preemptive right. And now we're talking about underwriting. Same idea here. When an issue has already been done and a company has shareholders and they issue an additional offering, a secondary public offering, an additional public offering, an add-on public offering, a public offering other than the initial public offering, in which case their common stockholders are going to be issued rights so they can maintain their proportional ownership. And as I said when we talked about the derivative, there are several things that could occur. One, the owners could exercise them, in which case they're buying the securities at a price below the current market value. They could sell them. And if they sell them, those people could exercise them. Or they expire. So either the user could exercise them or let them expire. They could sell them to someone who exercises or lets them expire. The ones that expire means those shares of this additional offering were not purchased yet. All of those rights that were exercised means the shareholders purchased the new shares. With this one, the ones that expire means those shares weren't actually issued. No one bought them yet. A standby underwriter is saying we will buy all of the securities that your current shareholders and whoever they sell to don't use. Whatever rights expire, we will buy the shares represented by them. It's related to a firm commitment, except firm commitment is now in an initial public offering. Most of these are dealing with initial public offerings. Standby is really the only one that directly deals with secondary offerings. But the firm commitment is where the underwriter goes, oh, you want $100 million? Okay, here's $100 million. Now, we're responsible for selling it. Whatever doesn't sell, the underwriters lose. They have already paid me. I got my money. I'm out. Now, the way underwriters get paid is by what's called a spread. If I want $100 million, I'm actually probably issuing $105 million in securities. And that $5 million difference is what the underwriters get to keep, because they're selling it at a total of $105 million, but they're giving me $100, and the $5 is what they keep. Maybe the stock price is $50. If you buy it in one of these offerings, you're going to pay $50 for it. But the underwriter is giving me, the issuer, $49.50 or $49.60 or $49.30. They're keeping the difference as the spread. And we're going to see, I actually have a prospectus that I will be showing that will show what the effective spread in an offering that we may be, at least some of us are probably familiar with the company that we are talking about. There are certain offering documents. There are 3 primary types of offering documents, but it really depends on if you're talking about stocks or if you're talking about like mutual funds. So we're going to go through what they are. I'm going to show you the sort of similarities, but there are differences. There are effectively 6 of these that we've got to at least have a cursory understanding of. A tombstone comes from stocks. It advertises an upcoming IPO or a recent IPO. That recent IPO is something I only recently actually learned. I thought it was only upcoming. It theoretically could be a recent one that has already occurred. It is not a prospectus. And a disclosure must be included at the bottom of the tombstone. Now, it depends on if it's advertising an upcoming IPO or a recent IPO on whether or not you can actually sell the security. If it's an upcoming IPO, the no SARs are there. You cannot sell, advertise, recommend, or solicit until the full, final, complete prospectus has been issued and the offering has been approved for sale. Now, if this is recent IPO, that means a prospectus has been issued, which means you could buy it. Depends on if an IPO has occurred. With stocks, now we have a red herring or a preliminary prospectus. This is solicitation for indications of interest in an upcoming IPO. As this is preliminary prospectus with a red herring, you can never sell. You can't purchase. No checks can be sent. They can't hold or guarantee sales. They can send, hey, when you can finally sell this, give me a call, I'm interested. Now, as I mentioned, I was going to show you a picture from a prospectus of a company we may be familiar with. If you haven't heard of this company, don't worry. It's reasonably small. I can understand why you may not have heard of this company. But we call this a red herring as a preliminary prospectus because it's got this red border text. It's warning of it hasn't been approved for sale. I hope you guys understand my joke about not knowing about Facebook. I would certainly hope most of the people watching this at least know that that is a company and recognize it. But there's no prices. You can't sell anything because there's no price. It gives you an estimate on how many shares, and it's an estimate. Nothing's final. All of these numbers can change, and they do. It tells you the expected stock price. The expected offering price is going to be $28 to $35. Even that's wrong. It was more than that. We're going to show you the final one in a minute. But these names down here are the underwriters. As I said, relatively small banks. I'm sure you guys haven't heard of any of these. Morgan Stanley, JP Morgan, Goldman Sachs, Bank of America, Merrill Lynch, Citigroup, Credit Suisse, Deutsche, and Wells Fargo. Most of you are probably familiar with. And you likely don't think of them as small neighborhood banks. These are big companies. But even these companies couldn't risk Facebook failing when they issued it. Even Goldman Sachs, JP Morgan, the big banks, they couldn't risk this failing. So they joined together and formed this syndicate. The final prospectus, again, we are still with the stocks. The 3 now with stocks, then we'll go with the 3 with the investment companies. But the final prospectus must include anything that a reasonable shareholder would need to know before they invest. It must be included in that final prospectus. The current prospectus must be delivered prior to or during the sale. By the time the last signature or the last button is pressed, they must have the current prospectus. There are very few universals in this industry. Very, very few. I like stressing that before I make one. Never mark a prospectus. I don't care how innocuous, how innocent, how minimum it seems. You've got this little old lady client who lives next to another little old lady client. One of them was coming in to pick up their prospectuses. They just wanted you to pencil in the top corner their name so they know who gets. No pencil, no pen, no dog ears, no highlighters, no sticky notes, no bookmarks, no marking, modifying of any kind ever, no exceptions. So here is the actual prospectus from Facebook. You can go back and watch again and look and click previously to look at the red herring if you really want to. I'll include the pictures of both of them, even though they're not, unfortunately, great quality, below. But we can see they increased the number of shares because Mark Zuckerberg actually sold some more of his. And they now have the price, $38. It was $25 to $35 before. It was $38. And the underwriters are getting paid 41.8 cents a share, not even 42 cents a share. So every $38 that someone pays, the underwriters keep less than 42 cents. Why would anyone do that? 42 cents? That's not enough to do this. Well, they made $176 million in 42 cents increments. In this industry, you may not think that fractions of a penny are a lot, and they're not. Making a half penny a trade doesn't seem like a lot of money, doesn't seem worth it. Well, if you make a few million of those trades a day, all of a sudden a few million half pennies starts to be real money real fast. When you sell 421 million shares, making 42 cents, a little less each, yeah, you're starting to talk about real money real fast. But they raised $16 billion. That's why none of these companies could withstand that. Yeah, any given one of these probably could take a $16 billion loss and still be standing. They wouldn't like it. They would really not like it. And they would rather make $50 million, $30 million, $20 million instead of possibly 176 or possibly negative $16 billion. Too much risk there. That's why they divvied it up. Mutual funds are slightly different because when we're talking about like Facebook IPO and the documents for that, it's a brand new security. Mutual funds have been around for a while, so then the comparisons are a little bit different. But an omitting prospectus, one that omits certain material, it omits key information in some of the disclosures. It's primarily the advertising of mutual funds. It's sort of a tombstone. But since this has already been released, since this mutual fund has almost certainly been out there for at least a few years, if not significantly longer, you can sell it. There's no rule against selling it here. The summary prospectus summarizes the final prospectus. It provides information from the final prospectus that investors need in plain English. Must explain in the summary prospectus where to get the statutory prospectus. That's the final prospectus. We're going to get that in the next slide, or you can look at the notes below in your notebook and you'll see that. But it's going to have the investment objectives, the fees and expense tables, the principal strategies, the risks and performance tables, management information, who's managing it, what's their experience like, purchase and sale information, how can you buy it, how can you sell it, tax information, and financial intermediary compensation information. It's sort of like a red herring, except this actually is what you generally use to sell a mutual fund. You can sell a mutual fund, you can include an application with a summary prospectus, provided it explains where you can get a statutory prospectus. The statutory prospectus, again, mutual funds, is the long-form, traditional prospectus, the mutual fund's final prospectus. Now, the current prospectus must be updated at least annually. And the fund's current portfolio is not going to be included. Right now, it is November. If the company's prospectus is updated every June, how could it possibly have the current portfolio as of November? Now, when it was made, the June portfolio, what it was at that date when they made it, absolutely is included. But the one today, how can it be there? It's paper. It doesn't change as my investments change. You can look it up online. You can find it other places. It's just not in the prospectus. But the information can't be more than 16 months old. Now, this gets a little weird. If it must be updated at least annually, how can information be more than 16 months old? Well, again, let's say it's November. That's the 11th month, so let's look back 6 months. That's May. So in November 2018, I am releasing my prospectus. I release my company's prospectus every November. Okay. And I use information from May of 2018. Okay. No problems there. It's less than 16 months old. The problem is going to come 16 months after May. So the problem's going to come in 2 months ago is going to be September of 2019. Because in September of 2019, that information from May of 2018 is now 16 months old. So what do? I'm going to release what's called, and we'll discuss on the next page in a little more detail, the Statement of Additional Information, updating that, where in September of 2019, I'm going to show May of 2019's data. Just to update it. Now, the Statement of Additional Information is attached to keep it current, but it doesn't extend the life. Come November of 2019, I need to make a new prospectus. I make my prospectuses in November. Even though I've got to update it in September's, doesn't mean I don't have to still make it in November. So I make it November of 2019, using May of 2019's information still. Well, September of 2020, I'm going to need a Statement of Additional Information showing May of 2020's information. If it's requested by an existing shareholder, it must be given within 3 days. If requested, you have 3 days to provide it. And again, these are all online, so the client's going to do it. I remember back in the Stone Age, when I used to be in the business more and actually selling these by prospectus, we had paper prospectuses. By the way, the Stone Age was like 2007, 2006. Paper prospectuses. Now it's all online. You just have to give them the email, the website, and they have to sign that they got the website. No one reads prospectuses. Don't worry about that. I always used to joke about how prospectuses, the paper ones at least, were incredibly useful. They were nice and thick and heavy, great as a doorstop. If you knew anyone that had insomnia, start reading 2-3 minutes, out like a light. Great for bringing camping. The paper's nice and thin, catches fire real good, good for kindling, starting campfires. Nice, heavy, thick book, big book, good for smashing bugs. If you got a bug problem, it's good at smashing bugs, maybe small rodents. Lots of uses that a prospectus had. No one's going to read it. So they figured out a way of putting it online. Public versus private securities offerings. Most of the time we deal with things that are public offerings, at least in the day-to-day world. And when we're professionals, we're going to be dealing with public stuff. But we do need to recognize that there are private securities offerings. Public offerings are offered to the public. This is sort of self-explanatory to a degree. These are generally going to raise a larger amount of capital from a larger number of investors. The private securities offerings are released for sale only to accredited investors, such as investment banks, pensions, mutual funds, along with some high net worth individuals. Primarily, they are actually going to be going to institutional investors, though some private offerings are geared more towards the accredited. But a lot of them are institutional, the banks, investment companies, mutual funds. These are generally going to be a smaller amount of capital raised from a smaller number, a more limited number of investors. Here's our cartoon. I'm looking for a fierce negotiator to protect my interests against a formidable adversary. My kid wants a raise in his allowance. Now, I threw some of these words around a little bit earlier. Initial public offering, secondary, follow-up. An initial public offering is the first time, the initial time that a company sells its common stock to the public. The follow-on public offering or a subsequent public offering, any time after the first time that a company sells its common stock as a new issue to the public. Rights to maintain proportional ownership for existing common stockholders must be maintained and observed. There's a secondary offering. Secondary offering is different. This is a large block sale of a previously issued security. The blocks are held by large investors or institutions and proceeds go to them, not the issuing company. The example that I give here is, as far as I know they used to be, they may not be anymore, they're at least a very large shareholder. The largest shareholder of Coca-Cola is Berkshire Hathaway, Warren Buffett's company. Warren Buffett owns, I believe, 400 million shares of Coke? It may be that was his initial purchase and he's got more. I know Berkshire Hathaway makes something like $1.6 million a day in Coke dividends. Again, $1.6 million a day in the dividends. But if Berkshire Hathaway was going to sell 400 million shares, they wanted to sell all of their shares of Coke, they could do a secondary offering, a large block sale of previously issued Coke stock, and the blocks are held by a large investor, in this case Berkshire Hathaway, or the institution, which is Berkshire Hathaway. The proceeds would go to Berkshire. They were selling the Coke stock. It doesn't go to Coke. Shelf registrations and distributions. These are weird. I even mention it in the notes here. The public offering where certain issuers, you don't really need to go into what the issuers are. This is one of those areas where if they ask you, it's going to be pure definitional. They are allowed to offer and sell securities without separate prospectuses. They can do sort of smaller offerings of multiple things, all in the same document. Like they could register 50 million shares. They could register $500 million of bonds, $750 million of convertible bonds, 75 million warrants, all in one document. But they're not selling them all now. Maybe they're selling 10 million now, maybe they're selling 100 million in bonds, maybe they're keeping the convertible bonds till later, maybe they're keeping the convertible bonds, or they're selling the convertible bonds and keeping the shares so that if someone converts the convertible bonds, they can just use the shares. There's all kinds of things that they could be doing. But before each actual offering to the public at this point, they've written their registration, they've done the shelf registration. Before they offer any of these securities for sale, they may need to file a short statement if anything is changed regarding these filings. But for instance, they can't change the price on these things. There's certain things that they're not allowed to change when they do it this way, and these are generally for smaller companies. Exempt securities from registration. Certain securities don't have to register, at least not with the SEC. Other things watch them. U.S. government stuff, well, that's watched by the Federal Reserve Board and the Department of Treasury. Municipals, the MSRB covers them. The money markets, bankers' acceptance, jumbo CDs, commercial paper. I don't know if it's the Federal Reserve Board, Department of Treasury, or both that basically handle these. And anything issued by insurance company or trust company, charitable company, things from Canada. There's a longer list of them. So you're going to want to look through that. But these are the basic big ones that you do need to recognize as exempt securities. There are exempt offerings. The primary one we need to be familiar with is called Regulation D. It is a private placement, a private offering, small number of people, smaller amount of money raised, sold to no more than 35 non-accredited investors. Accredited investors, I think I've been using shorthand so far, basically means rich person. Definitionally, it's anyone with has a net worth of at least $1 million and has earned at least $200,000 in the past 2 years, $300,000 married, with an expectation that it will continue. It could be sold to lots of rich people, but it could also be used if I wanted to sell some of my Securities Guys stocks to some of my friends, to raise some money for my business by selling ownership to some of my friends. I could just do it to no more than 35. It's also referred to as letter stock. How likely you're going to see letter stock, who knows. But Reg D is a private placement, is an exempt offering. That brings us to the end of the Securities Act of 33. Up next is Securities Exchange Act of 34. These two are the two largest. If you look through your notes, you'll notice that the Investment Company Act and the Investment Advisors Act, the other two of the big four Securities Acts, are much smaller in the notes than either the Securities Act of 33 or the Securities Exchange Act of 34. Hope you enjoyed this class. See you again shortly.